Hey, good morning, options traders, and happy Friday, everyone. I hope everyone is gearing up for a really big 4th of July weekend. Looks like we might be getting some rain here in Florida, but hopefully we'll get enough of a break to at least catch the fireworks. So for today, what I thought would help the traders in our group is to understand some option price boundaries. But rather than talking about all of the math and the arbitrage and the reasons that these boundaries must exist, let's do it in a visual form. Let's look at a graph. Now, all of the details I do cover in the Alpha Trader class, but at a minimum, you should at least have a pretty good idea of where call and put prices can exist. So when it comes to option prices, remember the key points are that option prices can't be anything. There are certain boundaries, certain strikes, expirations, certain stock prices where other option prices simply can't exist. And so again, if you understand these, or at least have a pretty intuitive feel, if you understand these boundaries, it will help traders to identify potentially good trades, bad ones. It will help you to see risks and rewards. So again, we're just going to be talking about call options for today, but let's jump over to a graph to look at these boundaries visually. So in this graph, we're looking at, let's say, stock prices across the bottom and maybe potential option prices up here. This blue line sits on a 45-degree angle, and I've talked about that before in previous classes. This is the risk graph for long shares of stock. It's always on a 45-degree line, and that's because stock prices gain and lose dollar for dollar. So on a graph, that's always going to be this 45-degree line. Over to the right, we have a similar line, but it doesn't start until 100. So I'm assuming that we are looking at a $100 call, and it's also on this 45-degree angle. Notice that this red line is parallel to the blue. It's just that it's shifted out by $100. It doesn't come into play until the stock hits $100 or higher. But at that point, at expiration, the option will capture dollar for dollar, just like the stock. So that's why they're running parallel. So the first thing to notice and to remember, for those of you who have had the Alpha Trader course, that a call options price cannot be greater than the stock's price. It just wouldn't make sense to pay more than the very thing you're going to exercise and receive. And if it did happen, there's an arbitrage. And so that's how we know that a call's price, no matter what the expiration, no matter which strike, no call option on the board could ever be greater than the stock's price. So if we look at this entire space of potential stock prices and option prices could not fall into this region. That's just an impossibility. Over to the right, we also know and learned in the Alpha Trader class that an option has to trade for at least its intrinsic value. That's an important concept. So this distance from the bottom of the graph to the red line is the option's intrinsic value. And no option, whether a call or put, could ever trade below the intrinsic value. So these prices are out of bounds. They are simply not going to exist. However, prior to expiration, we can tighten up this boundary a little bit, because for call options, we also have to account for what's called the cost of carry on the exercise price. And this is really important for understanding certain strategies and time decay, calendar spreads. A lot of strategies are making use of this pricing boundary. So in the class, I talked about specifically an option has to trade for at least the stock's price minus what's called the present value of the exercise price prior to expiration. So let's say that we've got maybe 6 months or a year till expiration. This red line is no longer the top boundary. This one becomes a tighter boundary. So this little added area right in here is another place that option prices could not exist. We've got to account for that cost of carry. And once again, this is assuming that we have some time to expiration. So right now we've tightened it to just this little white area right here where all option prices, all expirations must exist. But now let's say we've identified a certain strike, maybe the 100 call, and we're saying this is its price. And we feel that this is the fair value of the options price. It's a single price. Well, if we're looking for a longer dated option, maybe the same strike, maybe for a calendar spread, we know for a fact those option prices must sit up here. They could not fall below. On the other hand, maybe we are looking for the same expiration but a different strike. So I also talked about the relationships in the strikes. And for calls, lower strike call options have to be worth more money. They give you the right to pay less for the shares. So if this black line represents the price of a 100 call, maybe we're looking at a 105 call. And because that's a higher strike call, it would have to be worth less money. But there's another pricing principle that says it can't be anything less. It would have to be a maximum of 5 points less. So its price would have to sit somewhere in this range. So the main point from all of this, even if you didn't quite understand that, and you probably won't unless you've taken the pricing principles and really understand the details, the important point is that you at least understand that option prices have certain boundaries that they must exist in. There are certain places that they just can't go. So as prices start to move, as implied volatilities start to get pumped up or completely stripped clean, sometimes these boundaries get pushed and they can create really good trading opportunities. They can also create great risks if they're getting pushed in the wrong direction. But you need to know where these base levels are. And hopefully this gives you at least an intuitive feel of why there are certain boundaries, in this case where the call options can exist and where they can't. So like I always tell traders, it's not just about understanding the strategies. You can't go out and just say, what's a calendar spread? What's a vertical spread? That's understanding the definitions and how to construct them, but you have to understand why you're doing it. You also have to understand how. You need to know the details of these trades to see if it's worthwhile. Knowing the strategy and how to put it on isn't enough. You need to know why you're doing it. And the way that you know that is to understand your pricing boundaries. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.